welcome to today's webinar, everyone. I'm going to start off by introducing you all to Insurio. So you may be asking, why Insurio? So as you can see, this is the dashboard right here. Insurio is a life insurance CRM, and it's actually built by life insurance agents for life insurance agents. And it's included at no cost when you work with Penny. And what we're known for is high compensation, exclusive product access, top-rated e-app tools like iGo, Firelight, quoting access for major carriers. We offer full-service support, so case management, app fulfillment, policy delivery, and we have best-in-class underwriting and illustration help. So what makes Insurio a game changer? So as you can see right here, you have all-in-one carrier access. This is the quoting platform right here. So quote and submit applications for top carriers like Banner, AIG, Protective, Fidelity, all within this seamless platform. And we have smart automated marketing. So we're able to convert more you're able to convert more leads with pre-built, proven email campaigns. So as you can see, some of the templates right here. And then we have marketing campaigns. And we even offer a done-for-you website. As you can see right here, this is just a website that was created for me. So you don't have to waste time building a site from scratch. Every agent gets a modern, mobile-friendly, auto-generated website with built-in quoting tools, email opt-ins and scheduler, product info, and carrier listings. And it's fully customizable. So everything you've seen, the CRM, marketing automation, quoting tools, and a full-featured website is available for free when you work with Penny. And without further ado, I'm going to turn it over to Matthew. So I'm going to stop sharing my screen.
Yes. Hi, everyone. Thanks for joining the call. And Chris, thanks for having me on today. I am just going to go over our product. Let me share my screen here. Let's see. Okay. All right. So now you should see my screen. So yeah, I've been with Allianz for a little over 6 years, in the industry over 15. So and here at Allianz, we have only one life insurance product, and that's what I'm going to share with you today. It is our Allianz Life Accumulator IUL. If you're not familiar with Allianz, we're a very large annuity carrier. We've led the industry, I want to say, like we've been in the top 3 in the last 20 years, and been the most sales in a lot of them. And so we are very good at indexing, and so that's why we're in that space. It's kind of our bread and butter. We're not in the term space. We're not in the protection really base. So when you're looking at our product, it is going to be more the cash value insurance, looking forward to supplement income. So what I'm going to go over today is just our product overview, kind of what makes our product tick. And then at the end, I'll open it up for any questions you guys have. But again, I thank you for taking your time out of your day to learn a little bit about who we are and about our product. So my agenda is just to go over our product and then some of our allocation options. I really want to touch on number 3 here, our index lock. That is one of our key features that sets our product out than a lot of other IULs, if you guys work that space. And then flexible access to cash value and customize the policy. So if with Index Universal Life, these are the 3 buckets. Obviously it has death benefit protection for insurance, and then accumulation, flexible access. When I look at this slide, I do key to look at it is accumulation. Why you get somebody into this product compared to like maybe a whole life or a guaranteed UL is really that accumulation piece. Where most of the clients, I would say, when you're looking at a client that might fit this product, it's going to be somebody who has the discretionary income to overfund a policy, not looking to minimally fund it. I would say, typical, target market is that person who's been in their career for some time and has that, some money to put at a life insurance policy. And sometimes it might be that it could be a person that maybe has maxed out their qualified assets. maybe they have a bunch of money just sitting in a savings account, not earning much interest. That's where a life insurance policy can really make sense as a non-qualified asset, because you have really that tax deferred growth, tax-free death benefit, and then in the form of loans, tax-free income as well. So, but the nice thing about it is it does offer the protection, the death benefit. It has the chance for accumulation, and then flexible access in the form of loans, and then also our chronic illness rider, which I'll touch on in a little bit. So if you haven't worked much with indexed universal life products in the past, the great thing about them is that you're not really invested like in a variable product in the market. So downturns in the market isn't going to impact your cash value. At worst, it has a 0% floor. So if the index doesn't perform, the client isn't getting anything interest credited to them, but at least you have that downside protection of that 0% floor. And then with an IUL, because not only does it offer that death benefit, it has that, that your money, your premium money is getting put in their different index options. You watch those index, options grow, and then their cash value grows, and then in time, you can turn that in the form of loans and income on the back end. So when you look at your index allocation, this is just an example on this slide of, let's say, the client starts out the year, it's up 5%, it drops down, down to negative, and then it goes up throughout the year. And so wherever it ends at typically is where, you're going to get that credit for the year. So if it has a positive return, your client's going to get positive, but if an index shows a negative return, you're just going to get that floor 0. So that's really something to remember when working with index products. So currently in our lineup of index, if you do work in the IUL space, you're probably very familiar. Well, any index, the S&P 500, pretty much everyone's familiar with that one. So we do have that one, but we do also have 4 other index options. The top 2 are our Bloomberg and PIMCO. Those are going to be our volatility controlled indexes. Our Bloomberg is volatility that exposes a few different equity components. And then the PIMCO has a bond and equity component. When I'm talking about volatility, it really has a tracking mechanism on what the market is doing, and then shifting weight inside of it depending upon, if the bond market's down, it's going to have higher equities. If equities are down, we might invest a little bit more in bonds. So that's the PIMCO. And then in the Bloomberg, it's managed, and it's more made up of equities, but there is some volatility as far as what controls in it. Now, when we're talking about these indexes, I don't go over them in very much detail, but we do have an index allocation guide that you're going to have all the historical performances. We also can provide links to both Bloomberg and PIMCO, so you can track what it's past performed, what it's been, how it's been weighted. And then with the blended futures, it is a mixture of both 60% equity and 40% bond. And then on the S&P futures, they're very similar to the S&P 500, but with our product, the S&P futures is uncapped, whereas our standard S&P is going to be capped at 12.5%. And then we also do offer a fixed allocation, which is one of the highest in the industry, currently at 5.5%. And so that's a strong thing that you can certainly put money into as well, just to make sure your client gets a positive return. You can, with all these index options, you can allocate up to 100%. You can have a mixture of all of them. We do a lot of times preach diversification with our product. We just think it makes sense to have your toes in a little bit of in a few of them, just in case one index has performed badly, where you have that chance of getting a 0. Maybe another index performs well, and you're getting the client some sort of return. And there's a lot of flexibility with index allocations. You can change these on an annual basis. You'll have 30 days after the anniversary date to make any changes. On our statements, it's going to show what the upcoming participation and cap rates are going to be at. Now, the top 4 here are all going to be uncapped. The only cap that we have is on our standard S&P, but otherwise all the other ones are going to be uncapped indices. And what I will do as well, and I'll provide Chris after our call that he can get out to you, is our index allocation guide. Again, that's going to give you more details of our index options. I'll also include our current rate cap sheet that'll show the current rates and all of that. So you have that. But the historicals are good to look at on that guide. We have 3 different crediting methods. So typically, the ones you guys might be used to is annual point to point. That's pretty common in the industry, where you're basically just looking at what the index value is today, comparing it a year later, and that's going to determine what kind of credit the client would get. If it's, like I said, showed in that previous slide, if it's up, then we'll apply that. If it went to 0, they just won't get anything credited for that year. But we do have 2 other crediting methods, our monthly sum and our trigger method. Those are solely going to be tied to our S&P 500 index. And how the monthly sum works is it does have a cap rate of 3.8% currently. And you're actually, instead of looking at the index on an annual, you're looking at it on a monthly basis, and you're taking both the positives and the negatives into account there. And so let's just say that S&P 500 had a continual climb month over month. You would, was over 3.8%. You basically could take 3.8 times 12, which is going to give you an over 40%, 45% return. Now, more than likely, the S&P 500 is going to have a little more volatility, where there's going to be some positive months, some negative months. You basically add all 12 months of those together, and that's going to determine, what percentage is going to get credited to the policy. The other option we have is our trigger method. That is solely tied to the S&P 500. How that trigger works is that our current trigger rate is 8.25%. So again, it tracks the S&P. If that S&P has a positive value from the previous year, then the client gets the trigger rate of 8.25. It could be as low as 0.1% on, as far as what the gain was. As long as it's went up from the previous year, they're getting the trigger no matter what. That trigger will show on each annual statement. That can change, but ever since we've been running this product, it's been around that 8%. We do have bonus options on our product as well. So basically, these are just enhancement kickers on top of whatever the return is. And so currently we have 3 bonus options, the FAR 2, the classic, and the bonus. There's no additional charges on those 2. The classic is a 1% guaranteed flat rate bonus. It's just going to be added on, basically paid throughout the year, but basically that puts the client's floor at 1%. Even if there's no return on the index, the policy will still gain 1% in that bonus. And then the other 2 are 15 and 40 are multiplier bonuses. That's just basically taking whatever the return is and adding an additional 15% or 40% on top of it. So simple math would be like if you had a 7% return, you would just take 7 times 1.15. That's just over 8%, 805. So that's basically what the client would get credited. And then that same math with the 40%, you take 7 times 1.4, we'd actually credit 9.8 to the policy instead of 7. Now with that select, as you can see on this screen, there is a 1% annual asset charge. So that basically is any money that's in the select would get that 1% asset charge. Even though you get that internal fee, I guess when we look at our bonus options, I do think that select can be the best option, just because I believe it's around 3.5% if the index has that greater return, then that 40% is going to give you a higher credit compared to the other options that we've had. Why don't because I just see there's like 5 or 6 of you on the call here. I'll stop there. I know we covered just a couple of things on the indexes and bonuses. Do we have any questions on what I've covered so far? And no problem.
I have a question on my end.
Yeah.
So what types of clients would you say are the best fit for this product?
Yeah, so I know I kind of covered that a little bit earlier, but I would say it's really good for juveniles or minors that have, they have such a long period of time where you're putting it can be like a lower premium amount that's going in, but after 30, 40 years, when you run an illustration, by the time, they may need to access it, with you could pay for 20 years or whatever, and then you could see pretty nice size cash values and income on those. But then also, I would say you're looking for a client that has that insurance need, right? This is insurance, but also maybe I always believe that insurance, like a cash value life insurance, can be good in someone's portfolio as non-qualified money, because let's say your client is in a certain tax bracket and they get to that age where they're taking required minimum distributions. Might make sense for them to take out some money out of the non-qualified, because they're not going to get taxed on any of that, and it could keep them in under a lower tax bracket. But yeah, just the tax advantages life insurance brings and makes it attractive to a lot of clients. But then you're also looking at the clients that, again, because we're not, if you have a client that's looking for the most amount of insurance at the lowest premium, that's not going to be our product. It's going to be, because again, our product is more designed to accumulate cash with our index options and some of the other features we have within the product. So it's going to be that client that's looking for, supplemental retirement income, later in life, and using it as the tax advantages life insurance brings.
Cool. And are there any case studies or success stories of agents effectively positioning this product?
Yeah, I do have a brochure. Again, I can send. We do have some things on that as far as how to position it, and the type of client to look at. We do have stuff on that I could send out.
Doesn't seem to be any more questions.
Okay, sounds good. Well, I'll keep on moving along here, and I'm going to skip over this slide. I believe I talked most about the bonus options. This again is just talking about our allocation lineup. I don't think I need to touch on the index allocations anymore, as I can send you that information. And of course, I can follow if you guys have any questions. If you're working with our product, I can go into more details on those. I want to spend a little time on our, on our index lock. Now, this is really in this IUL space. If any of you sell other carriers and you work with their indexed UL, this really makes our IUL unique in the market, as no other carrier can offer this type of feature, as we actually do. What's really cool about Allianz is we actually do own our own investment bank. We do our own hedging. Most insurance carriers out there, I mean, all of them really, use an investment bank to purchase their options and hedge when you're talking about the different index options that they offer. And so that's why a lot of times if you've worked with IULs, you're familiar with the term sweep dates, or maybe it might be an anniversary of like the 1st and the 15th. Well, we actually do our own hedging on a daily basis. We actually, because we're a German company, but we have our North American branch here in Golden Valley in Minnesota. We actually hedge for Germany as well. So we are trading billions of dollars a day. Why that matters is because we're not having to go to an investment bank to hedge, and that every time you do that, there's like a transaction cost. We don't incur that cost, so we can put it back in the product. So we and offer more competitive par and cap rates, but then also have a feature like the index lock. So like I was mentioning before on crediting methods, where it's an annual point to point where you're looking at one index value and comparing it a year later. The cool thing about the index lock is anytime throughout the year, if that index has a nice return, you can lock in that rate, so the client gets that rate come their anniversary. So we know you as an advisor and clients aren't going to be tracking these insurance policies on a daily basis. Most clients who have life insurance probably don't even look at their policy that often. Hopefully they look at their annual statement, if that. But what's cool about the index lock is you can track and view it online anytime. You can lock in online at any time, or you can even set up like an auto lock feature. So you can put a rate of return in there, and if the index ever gets to that return, it'll automatically lock in for your client, and then the client will get that credit on their anniversary. So I'm going to show you an example here. So this would be if your client got into the index, it starts out at 100 at the beginning of the year. Throughout the year, it has some volatility, as you can see on the graph here, the blue line. It goes down and up a little bit there. about the end of the third quarter, your client decides, okay, I'm sitting at 8% here. I'm going to lock that in to guarantee my policy gets credited at 8%. So the client, at the end of the year, if they wouldn't have done anything, the index would have been valued at 102, which would have been a 2% return. Because they locked in, they're going to get 8%, not 2%. Even the money that wasn't, if they're paying on a monthly basis, that money would still get credited the 8%, even though it hadn't been in the policy, because we look at plan premium. So whatever the plan premium is what's going to get that credit. Now, that prevents, like, if a client has a really nice size return, like, 20, 25, 10, 15, whatever that is, the client can't just put in just a bunch of money to get that return. That would be considered unplanned premium, and that money would go into a fixed account. In this example, you can see in year 2, the index value will start at whatever it ended at, not what it was locked in at. So again, in year 2, it starts at 102. And then this time, in this example, the client, we're looking at that orange line now, it locks in again at 108, so it's a 6% return. If they would have waited, it would have finished at 112, which would have been a 10% return, but they're going to get the 6. They're not going to get the 10. So it can work both ways. If you lock in too early and that index continues to climb up, you're still going to be at the lockable rate at whatever you locked in at. And there's 2 ways to initiate an index lock. You'll see when the client logs in, you're going to be able to see what the rate is at. So it'll calculate any par and bonuses into it, and you can either do a manual or an auto lock. So this is what a screenshot of the website's going to look like. You're going to see the actual index interest rate, and then you'll see you can either on manual lock requested, where you just basically check mark a box that will lock in the rate that day, or you can set a target. Now, how the target works is basically you can see that this client that's sitting at 7.77, if the client decides to put a 12% and a 7% on the lower, if the policy ever gets above 12%, then we'll automatically lock in that rate for the client. So they don't have to track it. They don't even have to know. They just know that they're going to get 12% if it ever reaches to that level. Now, same with the lower target. If this client's sitting at 7.7, they set a lower target at 7. If that index ever falls below 7, that'll initiate a lock as well. And we always look at the ending day's values. So whatever, it'll trigger that lock if the ending day values is either above 12 here in this example or below 7. And we make it easy for you advisors to run reports. So if you have a lot of business on the books with us, you can run a report that basically puts all your clients on a page or two. Everyone that's in the lockable index options that we have shows you what they can currently be locked in at, so it's easy to manage for you. This is available right through our website. And then you can also narrow down that report. So let's say you wanted to only clients that are above 8% currently. It'll show any clients that are above 8% within that specific index. So and this just kind of another example of the benefits of an auto lock, setting that upper target and a lower target. And so guaranteeing that the client, like in this example, is going to get at least 6 because they have a lower target. When it's, in year 1, month 8, it's sitting at around 6.5. And then the upper target is set at 7. So if it ever got before 7, it would just lock in at 7. It is important to note too, once the targets are in the system, they do automatically renew. So your client doesn't have to set a new target every year. If they're whatever they're set at, they'll continue. And you can always go in online and change the lock. So if before it's locked, if you want to change the percentage up or down, you can do that at any time. And then this also is just, I always tell advisors that the client doesn't even have to use this feature. There's no cost to it. It's just basically a feature of our product that if they want to lock in a rate, they can certainly do so. And then it is important to remember too that the lock is just for the year. So once they're locked in, they are locked in for the year, and then on their anniversary each year, that'll unlock. And you may have multiple locks because we have 4 different index options that are available to lock. So each one of those is going to be separate where you can lock in their return. So this is just a hypothetical example of Mark and Rose are setting a target. They own an IUL. They meet with their advisor. They decide that the current index is at 6%. They decide that they're going to set their upper at 10%, lower at 4%. And they can be either up or down as long as that lock hasn't been activated. So you can see the upper is at 10, end of day it ends at 10:05. That's when the auto lock would initiate. So the client would basically get locked in at 10.05%. We send out a confirmation letter confirming it's been locked. This is what the percentage they can assume that they're going to get on their anniversary when the credit happens. And then when you're setting an upper target, the request must be greater than the current index, of course. And then this just shows you the lower two. So again, this is at 8. They put it at 4. Remember, at the end of the day, it finished at 3.95, which is below the 4%. So then we'll lock it in at 3.95% for them. Our average lock since we introduced this a couple years back has been around 9.5%, which if you haven't sold a lot of IULs, typically when you're selling these, you're running around a 6%, average rate. So that's been the average lock. And then earlier this year, when there was the tariff announcements back in April, there was a lot of volatility in the market. I've seen a couple cases where clients have been locking in over 20%. So, which is awesome, right? That's a really nice return. Good story for advisors and to just show that the power of the lock option. Any questions on the lock? I want to make sure you guys understand that it is a pretty key feature of our product.
I'm not seeing any questions right now.
Perfect. Okay. All right. And then often when you sell our product or in running illustrations, we're often showing income. Again, when we're looking at a cash value life product, the accumulation is important. So we're showing you can take out loans or withdrawals. We have 2 different loan options that you can take, either fixed loans or index loans. So fixed loans, that money, the cash value that they take out is basically taken out of the index option they're in, and then we're charging them the rate either 2.9% if it's in the first 10 years or 1.96 if it's years 11 plus. We do credit 2% back into the accumulation value. So it like after year 11, it's like a wash loan, but you will see the loan balance go increase because that 2% is going into the accumulation value, not as a loan repayment. And then our index loans are currently at 5% is the charge rate there. So these rates are guaranteed for the life of the policy. They're not going to go up or down. The key there is on the index, that money is still participating. So even though they're accessing their money, that money is still working for them in the index option that they're in. So hopefully that index can outperform 5%, and then they're getting a positive arbitrage there where they're actually getting more credited back into their policy than we're charging for interest on the money that they've received. We have a lot of flexibility as far as like fixed and index. So let's say a client started out at a fixed loan, they're not making any repayments, and they wish that money was participating for them, they can move that loan balance over to an index loan on their anniversary date. Or you can have 50% fixed loans, 50% index. The money that is in the index, you can have in different allocation options. So if you want that strategy to be different on the loan money, that's an option as well. And the interest bonus applies still on those loans as well. And I just talked about the blending and the diversification where you can have it put in different allocation options. We do also have withdrawals. That's just a partial surrender. So what that's going to do is reduce the death benefit dollar for dollar, and then as well as the death benefit and the cash value. thing about withdrawals is you want to make sure you know what the client's cost basis is there as far as what they've put in, because if they're taking more money back out than they've put in, that can trigger a taxable event. All right, and then lastly on the product overview, I just want to make sure I go over our riders. So we have 4 riders that are included with the policy at no additional charge, which are the ones in blue here. The loan protection rider, because we're showing loans often in our designs, this is an important one so the client doesn't get hit with a taxable consequence and so how that works is basically if the client is loaning their policy, and let's say they get in a situation where they're not making repayments, the policy is underperformed, policy is running out of cash value, and the policy is about to lapse. Well, with an outstanding loan, if that happens, the policy could trigger, if that loan balance is greater than what they've put in their cost basis, that's going to be, the difference there is going to be taxable as income. So to prevent that, the loan protection rider, if the client's at least 75 and the policy's been in force for at least 15 years, they can enact the loan protection rider. The policy does pretty much become a reduced paid up policy at that point. Not much of a death benefit left, but the key there is they don't have to repay that loan back. There's no taxable gain there. So they basically, the policy ends for the most part, but they prevent any tax consequence. The other 3, the waiver of new charges is just basically if your client maybe decides to increase their coverage, there's not going to be a new surrender period. There's not going to be any additional charges in doing so. So it's just basically any added coverage or whatever down the road. There's not going to be unexpected charges. And then the terminal and the chronic, basically, because with the death benefit, if the client is terminally ill, which we deem 12 months less to live, they can access up to $1 million. If it's less than $1 million, up to 100% of their death benefit before getting paid out before they actually pass. And then with the chronic, obviously that's pretty common in the industry right now is having conversations with your client on what they're going to do in the event they become chronically ill, who's going to take care of them, what kind of protection do you have as it's getting inflated and extremely expensive. We have, if the client does get in that situation where they can't perform 2 out of 6 main daily living activities up to 90 days, then it's like indemnity. We don't show receipts or anything. We'll just send them, the amount that they request to be accelerated from their death benefit. Now, the max that you can do is 25% of the death benefit, so up to $1 million. So in that example, if a client has $1 million death benefit, the max that they could basically accelerate in year 1 is $250,000. That does impact the death benefit. Obviously, it decreases the death benefit by that. The cash value would proportionally decrease by the percentage. So you're taking 25%, your cash value decreased by 25%. And then there would be a discount rate. That discount rate would be taken from the amount sent back to the client. So that's going to be dependent upon how much cash value death benefit there is, then what age the client is. The older the client is, the less that charge is going to be. But if none of these riders are used at all, there's no additional cost. They're just basically built into the policy for the client to use if they ever need to do so. And then we do have 4 additional riders available that you can add on to our insurance policy. Our enhanced liquidity rider, we have a 12-year surrender period. So basically in the first 12 years that the client were ever to walk away from the policy, there's going to be that charge. So you can waive that charge up to 100% but then there would be an additional cost on a monthly basis as far as your monthly COI charges are going to be a little bit higher. And then you can also waive 50% if you want to waive half the charges. We also have a premium deposit fund rider. That's going to be used if you sold these type of life policies before to stay within guidelines. It's not often where you can just get a lump sum and pay that lump sum and just pay the policy up in one payment because there's tax advantages to life insurance policies. There's also guidelines as far as to maintain the definition of life insurance. There's max amounts that you can put into these policies as far as premium. And so what the premium deposit fund rider does is basically takes that lump sum, but spreads it out over a 3 to 10 year period. And during that time, the money that's not applied to the policy does grow at 6%. That's the percentage that we pay out on the premium deposit fund, which is one of the highest in the industry. And then we just spread that out through that 3 to 10 year period to stay within those guidelines. So you're going to use that on those lump sum if a client has a windfall of money and they really just want to cut you one check and just pay for the insurance and all at once. That's when you're going to use the premium deposit fund rider. We also have a supplemental term rider where you can blend in insurance. So we don't pay target premium on the supplemental. So you as an advisor is going to get paid a little bit less, but your client's going to see a little higher amounts of cash value or cash value and income by blending in term. It also can be good for maybe a client has a specific need only for a short period. Maybe it's to pay off a mortgage. They need some additional insurance, but only for 10, 15, 20 years. You could put on that term rider and then drop that term rider off once they don't have that need anymore. Maybe the kids get out of the house or they pay off that mortgage. And then waiver of specified premium rider, we can waive up a certain percentage of the premium or apply the premium that the client plans to pay to the policy in the event of a disability. So those are all customizable where you can add those additional riders at an additional cost if you would like. And then the last thing I want to mention, and I should have mentioned up front, I meant to do so. Right now with our product, we have our risk class upgrade program going on right now. And so basically any client that's either a table 2 or standard will get issued at our best rate class, which is preferred plus. So any standard, maybe you have a carrier that you just put through a client and they came back at a standard rating. Look at our product. Let's run an illustration, because if we run it at preferred plus, there's a good chance that premium could be lower or cash value is higher, whatever your client's looking for within the policy. So that's going to be going on till the end of the year. And then we don't have a specific end date on it, but just know that's going on right now too. And then I know I covered a lot today. It's so hard in an hour to go over and obviously remember everything I just went over. So we have a ton of resources out there. If you get contracted with us, you'll have access to our website. I'll also provide Chris our sales microsite that requires no password, that has a lot of good videos on it, a lot of good sales marketing material. You'll have access to our illustration software, our electronic application system. Once in there. With underwriting, our accelerated underwriting program, meaning where the client doesn't have to do any exams, goes up to $3 million, 18 to age 60. So basically there we're just doing like the MIB report, prescription database, motor vehicle, just pulling those. And hopefully, if everything's clean there, we can get an offer out pretty quick. Those accelerated underwriting cases, sometimes we can get a policy issue within 1 to 2 weeks. I would say on standard, when you're looking at life insurance policy, if it has to go through fully underwritten, those are the types of cases that usually last, around 1 to 2 months, depending upon, how quickly everything can get in by. So just wanted to give that time period if you haven't worked with us before, or kind of expectations to set with your client when looking at these products. But I'm gonna also, Chris will have my information that he can get out to you if you want to have a one-on-one conversation, or if you want to see an illustration design on what the product can look like. Be more than happy to do that. And I know we have like 15 minutes here. If you want, it'd be helpful. I can certainly pull up our illustration software and kind of go over a quick illustration on.
Yeah, that would be amazing.
Okay.
That'd be great.
Yeah, let me do that here. So I'm just gonna go home here. So I don't have time to teach you like all exactly, all the inputs on the illustration, but I'll show you kind of, with our product. So this is kind of just when you're doing benchmarking, when we look at ourselves to other carriers, typically we use a 45-year-old male. So that's what I'll roll with, is 45 years old. And again, remember, if a client's only looking at putting, in their 40s or 30s, and they're only looking at a couple $100, product's probably not going to look very good. It's typically ones that are going to be a little bit more overfunded. They have a little more money to throw at it. So let's say the client wants to put in, you know, $25,000 for 20 years. So typically how I would design that is, if your client is straight looking for the most income that they can get out of it, you're probably going to do a minimum face amount. And so what the system will do is, based on the premium you're telling it, it'll calculate the minimum death benefit that we can start out to stay within those insurance guidelines. So I usually go minimum face, and then I'll do an increasing death benefit for the funding period. So since we're gonna, in this example, fund it for 20 years, I'm gonna say we're gonna do an increasing death benefit for 20, and then we'll level it off in the 21st year. Now,
Hey, Matt, I hate to interrupt. I'm not seeing the screen for some reason.
are you still seeing my the resources?
Presentate. Yeah, the resources. Yep.
Okay, let me I might have to reshare this then. Okay, do you see it now?
There you go. Perfect. Yep.
Okay. So again, this is what our software looks like. I was just putting it, like, you can put the client information in here. I was doing a 45-year-old male. At Preferred Plus, we're typically running these right now because of that risk class upgrade program we got going. But again, I was just doing a minimum face amount. I was going to do an increasing death benefit from the years 20 to 21. Now, the reason I do an increasing death benefit is you can start out with a much lower death benefit than if you're going to level it off. And so I'm doing increasing the level, and then we'll pay, this client's going to pay up to age, you know, let's say they're going to retire around 65, they'll pay up to retirement. So they're going to pay for 20 years. And then when they churn 66 is when we're going to churn on income. So we'll just do, in the 21st year, run that out to maturity. Now, I just leave the riders as is. Now, index allocations, when you run our software, it's going to be between those 4 different index options, the PIMCO, Bloomberg, Blended, and S&P. Those are all lockable, and it's showing some diversification there. Our max rate, and this max rate is based on historical cap and par rates on the S&P, and this is basically the max that we can take out, is 6.65, as you show on the illustration. So that's what I'm running it at. But if we do a quick view here, this is kind of what we'd be looking at. So the client is putting in 25,000 for the, you know, for that 20-year period, which would be yeah, what if I do the math there, is that $500,000 or so that they've put in for the life of the policy. And come 66, they're taking out $92,000. So it takes about 5-6 years for them basically to take back than what they've put into it. But they've also, in the entire time, have had a death benefit over here of, it starts at 380. We're doing increasing, so as their cash value grows, so does their death benefit. But as you can see, when they start taking income, they still have a pretty sizable death benefit over here. So they're getting this income, and if they pass away, I mean, this does take the loans into account. So we're reducing that outstanding loan balance by this in the death benefit. But whatever year you're looking at, that's the actual death benefit that would go tax-free to their beneficiaries as well. So it's a perfect example of how powerful the product can be. Now, this does assume a 6.6% return. There's going to be years that it's going to be above that. There's going to be years that's going to be below it. There's no way to, you don't know what an index is going to perform year to year. But on average, when we look at a historical look back, which, we have some pretty strong indicators from our historical performance and our index allocation guide. Like I said, I'll send Chris the guides, and it'll show the historical performance of the indexes. That's actually, pretty accurate, that we can illustrate it at 6.6. But this is where you can do a lot of different things. You can, edit. We can look at, let's say because we were looking at what the target market is. Let's say you're working with a young child. Maybe they were just born, let's say they're a 1-year-old. And now you're doing minimum face increasing. Maybe the grandparents are paying for it, so they want to contribute $100 a month. and they're going to contribute that until they're 25, let's say. And then you could say, and you don't even have to show income here. We could just do, again, I'm going to do increasing for the first 25 years, then level it off. And then we could just do a quick view here. And again, you're putting in that. Starts out at $100,000 death benefit, anything were to happen to them. But by the time they're 65, they have over $809,000 worth of cash value, $970 in death benefit, with only putting in, I guess for the life, if I do the math on that, that's total premium of $30,000, right? So definitely works good for juveniles, also works good for middle income. Obviously these numbers are going to be different depending upon your client, and that's where illustrations can be really helpful on as far as what it looks like based on the premium that the client can put in them. And then if you ever want to run the report, you can just hit print illustration as selected, and then that brings up the PDF format that's printable and you can send to your client. I always urge reps that haven't used our product, illustrations are a good guide for you. They give you a lot of helpful information as far as just how the product works, goes over historicals, gives you the current cap and par rates on the product. So even though there are a lot of pages, they're definitely good to page through to learn more about the product before you present it to your client. So about 10 minutes there, Chris. I know we only have a few that still survived on the call. Any questions on the stuff I covered today? I know
there don't seem to be any questions. So if people do have questions, what's the best way to reach out to you?
Yeah, either by email or my phone number. Let's see, I'll put it in the chat here. I don't know if this is allowing me to chat. Anyway, Chris, I'll send you my email with my contact info. Forward it on to the the people that were in this meeting, and then they'll have my information there that they can directly call me or email me.
Sure. Yep. And to everyone that registered, within 24 hours, you will receive a recording of this webinar.
Awesome.
And with that, there doesn't seem to be any questions. So thank you so much, everyone, for joining us today. Like I said, within 24 hours, you should receive a recording of this webinar. So thanks for joining us. And thank you very much, Matt.
No, I appreciate it. Thanks for your time today and allowing me to be on the call and listen about our product. But yeah, please reach out, keep me as a resource if there's anything I can help out with.
Absolutely. All right. Thanks for joining us, everyone.
Yep. Thank you.
Bye.
Bye.